What is capital gains tax in simple terms?
Yeah, so capital gains is very simple really. It's the profit you make when you sell an asset, which is more than the cost that you purchased that asset for. So it's really simple. It's any profit you have made over the purchase price and have sold, you pay tax on that gain. So under the current rules we've got, individuals and some trusts, you get 50% capital gain discount if you hold that asset for more than 12 months. So only half the gain may become added to your assessable income and then you pay tax on that.
Yeah, and I think it's important to note as well that these are, federal budget announcements. These are proposed changes. It's still got to go through legislation and before we hit these commencement dates as well. But hi everyone, and welcome back to another episode of the Brokers Lounge. We've had a very interesting week with the federal budget being announced, and it's definitely thrown a few curveballs our way and everyone else's way. But before we get stuck into it, Eddie, aka Muchacho, you to hold heads. How are you, mate?
Good, mate. Good. How you doing?
Good. Very good. Yeah, it's busy, but a good busy and interesting busy.
Yeah. Definitely.
Obviously, as I mentioned, with the federal budget being announced this week, probably create a little bit more extra work for us as we re-navigate the financial landscape. But we'll get into that shortly in terms of some of the things, and we'll probably talk about a couple of different topics that have come out of the federal budget over the coming weeks. So I think to try and unpack it all in one podcast session, we'd be
25 minutes. It's not enough.
No, and we don't want to lose people's interest over 3 hours talking about the budget because I know they can do that. So, but today we're going to talk about just one part of it, and that was the changes to capital gains tax. Obviously, impacts a lot of people. So we're going to talk about whether this is going to reshape the property market. What probably we'll just break it down a little bit more in terms of what capital gains tax actually is, what the changes are going to be, assuming they get through legislation, which I'm sure the government will get it through. You're going to need to because they've got trillions of dollars worth of debt to repay. What it's going to mean for probably investors and also, I guess, first home buyers as well, because it's going to have effect on both sides of the fence. Whether it will impact rents and housing supply as well, and why people should avoid making emotional decisions based on these headlines. But to kick off, Eddie, I might just get you to run through what is capital gains tax in simple terms.
Yeah, so capital gains is very simple really. It's the profit you make when you sell an asset, which is more than the cost that you purchased that asset for. So it's really simple. It's any profit you have made over the purchase price and have sold, you pay tax on that gain. So under the current rules we've got, individuals and some trusts, you get 50% capital gain discount if you hold that asset for more than 12 months. So only half the gain may become added to your assessable income and then you pay tax on that. So, for example, we've got an example here, investment property purchased for $600,000, you sold it for $800,000. There's a $200,000 capital gain under current rules or previous rules, I should say. Potentially you only pay tax on $100,000 and the other $100,000 gets exempt. So, and then that 100K gets added to your personal income and whatever your tax bracket, you pay tax on that. Under the new rules, well, it's not very clear how that's going to be treated, but you're probably going to have 70% assessed towards your income. So you only get a 30% discount, even though I don't think it's a discount. Like instead of saying a 30% discount, you're paying 70% tax on that amount. So plus the inflation rate. So that's still being finalized and we're still trying to understand how it's going to work and how the asset's going to be valued. But in simple terms, that's what capital gains is. So obviously, if you've been an investor or you're like across these terms, you know fully how that works. Now, the question is whether that framework will look different, right? Because that's what the new budget is about. So what are the changes that are being discussed in probably a bit more detail, Carlo?
Yeah, and I think it's important to note as well that these are, I guess, federal budget announcements. These are proposed changes. It's still got to go through legislation and before we hit these commencement dates as well. But as you mentioned, the current 50% capital gains tax discount is now moving towards an inflation indexation model from 1st of July 2027. So the government announced that gains would be taxed on the real gain after inflation adjustment rather than just using the existing blanket 50%. So, and I'll give a bit of an example as to how that's going to work down the track. The good thing is existing gains accrue before this commencement dates are proposed. So we're talking about this 1 July 2027. They will remain on the current treatment. So good for those who have got something happening now.
Yep.
Yeah, sitting on gains now. Now, I wasn't too sure. Maybe you might be able to help me out here. Was it new residential bills were going to receive alternative treatment to this indexation?
I'm not sure if it's the capital gain. The new bill, just the negative gearing.
Yep.
I think the capital gain part will include everything.
Yep.
But to be confirmed.
Yeah, so, you know, like we've just mentioned, briefly touched on negative gearing. So that's another change that's actually happening as well. So it's all about housing affordability and moving that shift towards, you know, probably first-time buyers being able to get in, you know, access to more of the properties out there rather than just investors. But going back to the example that I was talking about earlier, that I was going to talk about earlier on, currently, and Eddie mentioned this as well, you know, if you buy a property, say you buy a $500,000 house, you sell it for $600,000 after 2 years, $100,000 profit, pretty simple, with a 47% tax rate. So it's about $47,000. Pay 50% of that, so you're effectively paying about $23,500 of tax on that $100,000 growth. From July 2027, the new indexation model or method means that you'll only pay tax on the real profit of the property price. That is the difference between the inflation adjusted property price and the sale price. So if we use that same example again of that $100,000, 40% tax rate on the difference of an inflation adjusted price, say after inflation it's adjusted to $530,000. Have I lost you?
Yeah, you did.
Sorry.
So on 40%, you said why the previous example we had the tax rate at 47%.
No, so we're talking about the highest, if we're working on someone on the highest marginal tax rate.
With the other example, is it based on 47%?
Yeah, still based on it. So using the same example of $100,000 profit, 47% tax rate on the difference of inflation adjusted price of $530 and the sale price of $600,000 will be 47% of the $70,000 gain. So it would mean $32,700 tax on $100,000 gross. So it's actually still more than what you would have under the blanket 50% rule.
So you're paying about $14,000 more.
Oh, it was about $8,000 or something like that. So on that $100,000.
Because that was $23,000 on the...
Yep, and compared to 32.
32.
Yeah, under the indexation model.
Okay.
Yeah.
All right. So bottom line, you're paying more tax.
Correct. Yeah.
Which is
I think the
50% and the 30 plus inflation.
Yeah, the hard thing will be is, you know, if people are trying to work through their numbers, like, well, it's based on inflation or indexing. So what's that going to look like? You know, in the past, we've always been able to go, well, we've got that blanket 50% rule. So we know that if we make X amount of gain, we know you can almost work out what your capital gains tax is going to be.
Yeah.
But you're probably not going to really know that going forward as much because you don't know what that indexation is going to look like as well.
But like between 3 to 7%, right?
Which can be a bit.
Yeah, but like that's it's like your HEX, right? When it gets indexed in June, it depends on the inflation rate. So always allow for 7%. Hopefully it's just 7. Like at the rate we're going, we're probably going to be 10%. But yeah, probably around 7%. So, yeah.
Yeah, so I think it begs the question, if these rules do get through, which I'm pretty confident they will, because they always seem to find a way of getting it through. But one of the questions that investors will, I guess, immediately ask is, how does this affect my numbers? So maybe, Ed, if you can just go through the potential impacts for investors.
Yeah, so like we discussed, obviously, number one is you're going to be paying more tax if you sell that property.
Mm-hmm.
And also, we're not talking about negative gearing, but that's a big part of investing as well, and that will have even more implications. So lower after-tax returns, you're going to have to hold the property for longer holding periods, just because you're pretty much relying on the growth of the property, because there's no negative gearing that you can benefit from in the short term. Obviously, investors will be more selective with which property and area they're buying in, because the focus now is on growing areas.
Mm-hmm.
That's where you're going to make your money from. And also greater focus on cash flow and rental yield, which is going to be tricky, because if you try to align the being selective where you're going to purchase and yields and cash flow, well, good luck, right? Because what people used to do were compromise on the area for the sake of yield, right? Or don't worry about the yield because they know the area is going to grow and it's a good area or suburb or whatever. So trying to find the holy trinity of area, yield, and cash flow. It's going to be tricky, but there's always options, obviously. So possible investor reactions would be, like we said, holding the property for longer, which in a way can have an opposite reaction to what the government's intentions are, because the aim was to improve supply. So if investors are holding property for longer, then probably that would obviously reduce supply. Also probably looking at buying different asset classes. So also we're going back to the negative gearing, because I think they're very much tied together from an investor point of view. So only residential property that's not newly built is like want to have the negative gearing benefit, but a commercial property is exempt. So I reckon we'll see probably more demand on commercial assets.
Was there also other type of assets like shares
and stuff as well? So that's also excluded. So, and plus new builds, right? So I think we'll have probably a bit more demand on these asset classes, and the investing mindset will shift towards just more diversification, I guess, in a way, which is good. I don't mind it at all. Also looking at stronger yield locations. So probably commercial, like if you're looking at a warehouse, will have a higher yield in terms of rent, but slower growth, right? So that was the case, right? So, but if all investors start putting money into commercial property, then that will grow as well. So whoever's invested already in commercial, I think they're in a good place. And reassessing future purchase decisions, I guess that's very important moving forward, just to understand how these new rules are going to have implications on your wealth creation, and how it's going to, affect your planning, your tax, your distributions, all that sort of stuff has to be tied together. And the way the things are moving forward, it becomes a bit more harder for an individual to work all these things together, right? So it's more important than ever having a good financial advisor, a good accountant, a good mortgage broker in your corner to help you navigate how you're going to invest and where to invest and what to do. So basically the key message here, property decisions should not rely on one tax setting, and investors generally look at rental income, equity growth, cash flow, tax outcomes, long-term strategy. So all that should be really come together, and you need to have a strategy in terms of where, how, when, how you do and invest so you know what the outcome will be, and just keep moving forward. So Carlo, basically, do you think these changes will help or hurt the housing market overall? Because I think the cover is helping the housing market, but really they just want to generate more tax income, the government. So will it help the housing market?
Yeah, I guess it depends on which side of the fence you're going to be sitting on with regards to this. And, you get people who will support this type of change to the CGT rules. They'll argue that it reduces investor advantages. So those who have got the ability to purchase these properties for an investment, which will obviously mean more opportunities for owner-occupiers. So which will lead to, if we look at the first-home buyers as well, where they may have missed out in opportunities in the past, may create a lot more opportunities for them going forward as well. Better housing affordability outcomes. So these are just some of the things that those who will like these changes will argue this. Those who will argue against this will basically be saying there'll be fewer investors entering the market. I think people will start to think twice about whether they want to invest in a property. Because like you said, there are other asset classes that may deliver better capital growth, better yields, may have better tax advantages as well, especially when we start talking about negative gearing. So there'll be definitely less investment into rental stock going forward. Supply constraints are probably becoming worse as well, which is going to, at the end of the day, have upward pressure on rents. So it really does depend on which side of the fence you're going to be on. If you're sitting there as a renter at the moment, you'll probably be a little bit more nervous because you know that rents are going to probably continue to go upwards.
Yeah, and that's simply due to the fact that less investors, so less properties to rent.
Yeah, the vacancy rates still remain very tight in a lot of areas as well. So, and at the same time, we've still got that population growth as well. So there's lots of people that I've heard argue about, is the whole immigration causing a lot more issues than what, the government's talking about as well. They're making these changes, but there's ultimately more to it that we need to control first to help ease some of these pressures that are happening.
They're not tackling the actual issue.
No.
Right? And that's what the governments have been doing for so many years.
Yeah, exactly right. And then my next comment here was, around...
Bins, right?
Sorry?
The machete bins. It's like we've got a machete issue. So.
Where are they? I haven't seen one. So, one of the key points to come out of this is that tax changes on their own rarely solve affordability issues.
It's not they rarely solve. I think they make the issue even worse, right? Because you're taxing people more, you're slowing the economy even further, you're making people poorer, you're not discouraging people to invest and to grow and to be attracting the good quality people to come and do what this country has done for many years, right? So by just taxing your way out of issues, you're not solving anything and you're making the issues bigger.
Yeah. So, I think they just saw the headline number of the national debt and they think, well, how do we peg this back so we look like the good guys? But yeah.
Well, look, to be honest, first of all, it takes courage and balls, which our politicians don't have, right?
Haven't had it for a while.
If you're getting paid by a lobby group, right, how are you going to go against it, right? How can you tax your resources, natural resources, more on the exports and increase your income there? How can you? Because we privatized a lot of our sectors, right? And that is
pretty much all of them.
Pretty much all of them.
There's not much left.
Exactly. So that is the biggest issue. And obviously, once you go down the privatization route, it's so hard to get it back, right? Because it's a private company running one of your best generating income assets.
Yeah.
And they find ways to increase their prices while maintaining the lowest possible tax or fee that they pay the government back. So taking these back is obviously you can't when you've got 99-year lease signed and the infrastructure that these private companies have built, like in the gas industry, they've built the infrastructure, and for them to just give it away. They're not just give it away. So
we could be one of the richest countries in this world.
We used to. Used to be.
Well,
right?
we've got so much under our soil. It's unbelievable. You know, one of the biggest countries out there in terms of land area.
Yeah.
We've got massive
But that's
energy.
our problem, right? Because like you don't want to be a country solely dependent on your natural resources. And then the moment that's gone, you've got nothing else to show for, right? You got to be able to use those natural resources to build the right economy, which attracts the right people, the right investors, overseas big companies that will employ more people, bring back your manufacturing, bring back your, which has all gone. And we're simply relying on taxing people to generate revenue and natural resources and the tax, which is minimal, that you get from these big companies.
Yeah.
So, yeah.
Yeah, I think the day we saw manufacturing pretty much die in this country, we could see the writing on the wall already.
Yeah.
That we'd be, 10, 20 years down the track and we'd be facing this type of issue.
That was probably 10 years ago.
Yeah.
Very long ago.
Yeah.
Right?
Yep. Yeah, exactly right. So, yeah, I know we're probably digressing a little bit off the topic of capital gains tax changes, but it's well worth noting because, we can continue having these federal budgets year after year and then trying to implement more and more changes.
Yeah.
But ultimately, we're still going to be in the same position in probably 10 years' time if like you said, we don't have politicians with balls to actually make the tough changes that are required. So I think it's almost too late, to be honest. and I feel sorry for, our kids' generation and probably 2 or 3 after that, because they're going to be the ones who have to deal with this, that's for sure. So, Anyway, in the interest of time, mate, maybe you just want to touch on what it means for first home buyers.
So, basically first home buyers might find an opportunity to enter the market now with like less investors competing on those properties they wanted to buy. But also the bigger part is obviously affordability. So you might find more stock, but then servicing remains an issue. Saving credit deposit can remain an issue. Elevated prices to get into the market can be an issue. So hopefully, I get it. Part of this budget will probably ease the pressure off the housing market in a certain way, because to be honest, property has been traded as a commodity for the last, I don't know how many years, right? And people just solely focusing on property as a wealth creation tool rather than as a basic necessity for any human being, right? So it's good to ease that pressure off the property market, but there's still a lot of challenges that you can navigate with the right assistance, with the right plan. You can tap into whatever schemes are on offer by the governments. So I encourage first-time buyers to.
It's probably one of those tough things because, these measures will hopefully add a little bit more availability to the first-home buyers, but at the same time, they're also being hit with stuff that's outside of this whole property game through cost of living, high fuel prices, all that sort of things as well. So it's like they get a bit of an uplift on one side, but they've been slammed on the other side. So I don't know if we're going to see a huge impact to first home buyers. I hope we do, because, if there's one part of the market you want to see, get in there and really get ahead in life, that's going to be one of them. But I'm just not overly confident personally.
So what do you think? Should investors make decisions now? Because I feel like a lot of people have put a hold on things.
Yeah, and I think it's typical because that's all we're reading in the headlines at the moment. It's around, you just want to avoid any panic decisions. Don't react to any of the headlines. Review your own numbers. Understand your own tax position. Like you said earlier on, engage your accountant, your solicitor, your financial advisor, your mortgage broker. Get the team around you to make sure you understand what these potential changes or what these changes are going to how they're going to affect you as well. So, but definitely don't panic just yet. Yes, you can put things on hold, but put things on hold to review and properly assess all your numbers. So
that's it.
And we all know that these are proposed changes. They may not end up going through.
Yeah, true.
I've got to keep putting that as a little disclaimer. So anyway.
So that's pretty much capital gain covered for today. Summarizing, obviously, There's a lot of noise out there. There's a lot of headlines out there. There's a lot of uncertainty, which was already there, and now it's just getting even worse. So my message, our message really is just don't get like tangled with all the noise that's going on and the, panic that's happening. Just pay attention, understand what's happening, understand the implications that have on you, understand what your options are, understand what your strategy should be, how it should be amended, how it should be changed. We're going to cover in other sessions like the negative gearing part. The bucket company and the trusts and the new tax rules around those as well. So you need to understand the full picture and how can you navigate the new rules, because wealth creation will always be a thing and you can always achieve it, but it's just you need to understand it. So thanks for today. We'll see you next time. Don't forget to leave us a review and subscribe, and thank you very much.
Take care, everyone. Bye-bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances. Head to the show notes if you want to book a free call to discuss your personal situation.